Hi, this is Tom Seifert, Senior Advisor here at Fairport Wealth. Let me state the obvious. Volatility in markets has returned, and unfortunately, most of the movement during the first half of the year has been in the wrong direction. I want to discuss a few items to consider with these markets in flux that may make the best of the current environment and set you and your family up for what is hoped future success. The ideas I will be touching on run the gamut, including income tax planning, estate planning ideas, and a few investment diversification ideas. The ideas that I will be discussing are only relevant for certain client makeups, and not all would be warranted or, for that matter, necessary. One's individual situation will dictate the relevance of the idea and whether it would be suitable. This is something that your team at Fairport Wealth can assist in determining if any of these ideas are something to consider and to explore further. A few income tax planning ideas. Improving the overall tax efficiency of your portfolio can help you reach your investment goals. Taking action during times like these, and not only at year end, can help you keep more of what you earn. As a strategy, tax loss harvesting involves selling an investment that has lost value, replacing it with a reasonably similar investment, and then using the investment loss to offset any realized gains. Tax loss harvesting only applies to taxable investment accounts and not within IRAs or 401ks. It should also be pointed out that another approach would be to double up on the stock position and then wait over 30 days, avoiding the wash sale rules, to realize the loss on the original lot. This way you get to maintain a position in the actual stock, realizing that after the 30-day wait period, it is possible that you may no longer have a losing position if the share price has rebounded, or that you might have a larger loss than you originally had should the share price continue to decline. Tax loss harvesting offers the biggest benefit when you use it to reduce regular income, since tax rates on income typically run higher than rates on long-term capital gains. Even if you don't have any capital gains in a given year, you can use up to $3,000 in capital losses to offset your ordinary income tax. Loss harvesting is only about tax deferral, not avoiding taxes, but is a strategy intended to reduce one's current tax bill. Usually people think of stocks and mutual funds for tax loss harvesting purposes, but with rates sharply rising, many fixed income holdings are underwater, and thus creating an opportunity to harvest losses in these positions as well. Until recently, this hasn't really been an opportunity set for tax loss harvesting, but now it's relevant. Just something to be aware of and take advantage. One should make tax loss harvesting an ongoing priority, whereby striving for those increased after-tax returns. Market conditions can change quickly. If you wait or only consider this strategy at year end, the ability to harvest losses can disappear. Happy hunting, but make sure any tax-motivated moves work within the framework of your total financial plan. Another idea is, if you're still working, you may want to consider increasing your contribution percentages to your 401k, whereby somewhat front-loading the contribution amount now while the markets are down. You can always change your contribution percentage back once your desired contribution amount is achieved for the year, but make sure you adjust it back for next year to get you back on your normal investment amount per pay. I also would encourage one to make any IRA, Roth IRA, or SEP IRA contributions now versus waiting until year end or even April 2023 if you know you will or already have the requisite earned income. Let's make those contributions while markets present themselves, as these vehicles hold, presumably, long-term assets that can handle the risk associated with the markets. Over time, this risk is mitigated by staying in the markets. We at Fairport Wealth continue to recommend Roth IRAs and Roth 401ks for a whole host of individuals. With a Roth, you don't enjoy a tax deduction going into the account, but when you make distributions, there's no tax to be paid. All earnings that have occurred in the account are completely tax-free. There are several ways to get money into Roth. A direct Roth contribution if you are below certain income thresholds, and if you're above those thresholds, possibly do what is called a backdoor Roth conversion. A backdoor Roth conversion assuming you have no regular IRAs currently, you simply make a $6,000 non-deductible regular IRA contribution, or $7,000 if over the age of 50, as there is a $1,000 catch-up provided. Then after a period of time, convert that IRA to a Roth IRA. Since you took no deduction upon contribution to the regular IRA, you have basis in the IRA of say $6,000. So when you convert the $6,000 to a Roth, there is no taxable income incurred. This takes a few steps, but worth the trouble. Alternatively, if you have an existing regular IRA of which you use pre-tax dollars to fund, that is, you took a deduction when funding the IRA in the past, and the account is no doubt down in value from the beginning of the year, you can look to do a Roth conversion at these lower stock values, and thus moving the future appreciation within a tax-free Roth IRA. However, you should note if you convert all or just some of your regular IRA to Roth, you are required to pay the income tax in the year you convert. As a side, and I've touched on this before, we have seen Roth conversions make a lot of sense for recent retirees for the period of retirement until age 72, the age at which minimum distributions are required of your IRA, as you now have available the lower tax brackets. Tax projections may be required to ensure that you are staying within certain tax brackets. Currently, many employers now have a Roth feature within their 401k plan that should be utilized to create the different buckets of retirement income. Especially younger individuals who are currently in the lower tax brackets should take advantage of Roth and/or the Roth feature within their employer's 401k plan. Looking forward, having a myriad of assets and account types can have a big impact on one's retirement and withdrawal options. One final note about retirement accounts. If you need to make a required minimum distribution from an IRA, that is you're over 72, and haven't done so yet this year, you should consider deferring making it until later in the year to see if the account has rebounded some. Moving on to a few estate planning ideas. Gifting assets to an irrevocable trust at today's stock market level allows one to potentially move more out of their taxable estate while utilizing a lesser amount of one's lifetime exemption. First, a primer. Currently, the lifetime estate tax exemption is a hair over $12 million per person. If your taxable estate is below that figure, double it if married, you will not be subject to a federal estate tax. Unfortunately, this generous exemption is to statutorily go down to around $6 million beginning after 2025. To get assets outside of one's taxable state and using the higher exemption amount available now, and while the markets have swooned, it may make sense to consider the utilization of what is referred to as spousal lifetime access trusts, or SLATs. This is a vehicle for married couples with extra investments. How it works: one spouse creates a SLAT, which is an irrevocable trust, and then makes a gift to the trust using some of their estate tax exemption. The other spouse would have lifetime access to the trust for his or her health, maintenance, and support. And at his or her death, the trust assets would then go to the ultimate beneficiaries, being one's children and/or grandchildren. Each spouse can set up a SLAT for the other, but you need to make sure they are not identical trusts. Lawyers know how to do this. This is a great vehicle for those unsure if they will ultimately need to draw on those assets versus giving them away outright and having no access. A few nuances. If a liquid or privately held businesses are contributed to the SLAT, you may be afforded significant discounts. Also, you can structure the SLAT so that the grantor, i.e. the spouse setting up the trust, gets to pay any tax on the earnings within the SLAT, which equates to a hidden gift to the trust. So what has been accomplished by setting up a SLAT? One has used some of their current and perhaps temporarily generous estate exemption using assets depressed in value. Their spouse retains some access to the funds, assets in the trust grow outside of your taxable estate, and perhaps even income tax-free if structured that way. Obviously, there are some drawbacks. You've got complexity, some loss of control. Assets can decrease further in value, so you've potentially wasted some exemption. No step up in basis at the death. And a spouse has a premature death, the assets go to the ultimate beneficiary, and a few others. But these issues can all be mitigated to a degree, but we'll save that for another time. We like the SLAT idea for those who are happily married and want to do some estate planning, but not ready to give up complete control and access to the funds. The current market valuation has presented the opportunity to maximize the utilization of a SLAT in a married couple's estate plan. A bit more straightforward idea would be to make any planned annual gifting now and let your children or grandchildren invest the money while the stock market is somewhat oversold. The amount of annual gifting allowed for 2022 is $16,000 before any gift tax exposure or requiring the filing of a gift tax return. As opposed to giving outright cash gifts to an individual, a better alternative may be to establish or simply fund an already existing 529 educational account plan for your children or grandchildren. You should note that there is an exception for gifting to 529 plans that allows one to turbocharge the account with up to 5 years worth of annual gifting. So an individual could put into the account $80,000, $16,000 for a deemed 5-year period, with no gift tax implications. If married, the math works out to $160,000. The funds can be withdrawn from the 529 plan for most typical college expenses, such as tuition and room and board. In addition, new rules allow up to $10,000 annually to be withdrawn for private grade and high schools. Many states provide for certain tax deductions for contributions into their respective state plans. Ohio's plan is called the College Advantage Plan, and if you contribute to it, Ohio provides for a $4,000 annual deduction per beneficiary. Any amount contributed to the Ohio plan over that amount may be carried forward until the entire contribution is fully deducted at a $4,000 per year clip. Ohio's plan also uses low-cost Vanguard funds as their investment options, which we like. It should be noted that even though it's Ohio's 529 plan, the funds can be used at any college or university, not just Ohio institutions. We really encourage Ohio 529 college advantage plans for those saving for college. Moving on to a few investments considerations. As the global economy continues to be impacted by geopolitical turmoil and the ongoing rise of inflation, coupled with recessionary concerns, we continue to assess the markets and work with investors who are currently grappling with their portfolio positioning and asset allocation decisions. Seeking diversification, non-correlation, reduced risks, and in an effort to dampen the volatility of one's portfolio, Fairport for several years has been utilizing what we refer to as our liquid alternative model. These assets have been included in client accounts where appropriate. The type of alternative assets that Fairport has utilized historically has been investing in this liquid alternative space. We have used a basket approach, investing in several different strategies. They include a core multi-strategy fund, non-traditional fixed income, long-short equity funds, event-driven, and managed future funds. Each type of fund has a different investment theme and correlation to the broader equity markets. We have been using this liquid alternative model in accounts for some time now. And for the first half of 2022, this alternative basket has proved to have held up rather well on a relative basis as compared to stocks with bond-like volatility. A more recent area that we have been using for those wary of the markets, and particularly for those with new cash to invest, we have begun using defined outcome exchange traded ETFs. These ETFs seek to track the return of a reference security. The one we have used tracks the S&P 500 index. The ETF tracks the index up to a predetermined cap or ceiling, while buffering investors against the first, say, 9%, 15%, or 30% of losses over the outcome period, which is a year. The ETF can be held indefinitely, resetting at the end of each outcome period annually. These defined outcome ETFs allow investors to take advantage of market growth while maintaining defined levels of buffers against loss. The ETFs are very tax efficient, generating little gain upon resettlement. Until recently, defined outcome strategies like these have only been available through structured products and within certain insurance products. By way of example, the actual July 1st, 2022 issue of the 9% buffer ETF that we use that tracks the S&P 500 index has a defined upside cap of 23.7% if it was purchased on July 1. So if the S&P 500 is up 25% from July 1, 2022 to July 1, 2023, you are capped at 23.7%. However, if the S&P increase falls somewhere between 0 and 23%, you would get that amount of gain when it resets. Should the S&P 500 index be down 8%, you would be down 0. That is, you are within the buffer. And if the S&P 500 is down, say, 12% for that period, you would be down only 3%, a negative 12% return minus the 9% buffer. All of this is accomplished through the utilization and layering of flex options that have varying strike prices, i.e. the price at which the option purchaser may buy or sell the security at the same expiration date. As such, each ETF is able to shape the return profile of the reference assets over the outcome period. We believe these defined outcome ETFs may be used as a complement for both equity and fixed income allocations in existing portfolios. Another area that we have begun looking to, where appropriate, has been the private market space versus just the public markets. These are asset classes with a longer-term investment horizon, and they allocate their capital over time. These private funds avoid the daily price swings and potentially can gather up bargains when markets fall. There has been an evolution in these private fund offerings, allowing the mass affluent to invest in these types of private investment vehicles through their advisors. However, it should be noted, to invest in these private offerings, one must be an accredited investor. Generally, an accredited investor is one with $200,000 or more in annual salary or over $1 million in investable assets. I recently read that only about 1 or 2% of the estimated $80 trillion of investments held by individual investors is allocated to alternative investments. This will no doubt increase as these vehicles become more available and their utilization may be required to meet one's savings goals going forward. The private market sectors that Fairport has been using have been private equity, private real estate, and private secured lending. Our affiliation with Hightower has helped identify and vet these private funds and allowed our clients to enjoy lower investment minimums, some as low as $5,000. These investments also can be held by your custodian, which by example is Schwab or Fidelity. I will briefly describe each type. Private equity. There are about 7.5 million private companies in the US, of which about 1.2 million of those have 1,000 or more employees. Not so small by any means. Compare that to only about 4,400 public companies in the US. This larger pool of private companies represents a significant opportunity set for private equity managers. We have used an evergreen private equity fund to gain access to small and mid-sized private companies in a cost-effective and relatively easy way to gain exposure immediately. The fund offers private company diversification by manager, geography, vintage year, and industry through a single fund. Also, the total fees are lower than most other private equity funds, and there are no incentive fees charged on the funds that we have utilized. The fund has held up well, and in fact, it was up about 5.9% through May. Full disclosure, you've all heard the warning that past performance is no guarantee of future results. Private real estate, or REITs, have historically provided competitive total returns based on high, steady dividend income from rents, coupled with the long-term capital appreciation potential of real estate. They have a comparatively low correlation with other asset classes and makes them a good portfolio diversifier that can help reduce overall risk and bolster returns. We have currently looked at funds that invest primarily in residential apartments in fast-growing regions and in the industrial and warehouse space, not in retail or office buildings. Dividend yields in the range of 5 to 6% can be expected. An additional benefit is that a large portion of the income generated may be sheltered by depreciation expense, thereby making the dividend very tax efficient. Further, during inflationary times, rents can be increased, allowing for increased income. However, the downside, rising rates tend to have a dampening effect on returns, as these funds are very capital intensive. Private credit. Private credit investment vehicles provide capital from a dedicated pool of funds that enable corporate borrowers an easier access to capital than from traditional banks. There is more than 1.6 trillion in assets in private credit funds, which is an increase of over 50% from just 5 years ago. Although private credit is usually more expensive than traditional bank loans, it offers more certainty and stability in pricing for smaller and middle market companies. Most loans issued by these funds are secured and have a floating rate structure, which is a real positive in the rising rate environment we are facing today. The typical yield on these private credit funds can range between 6 and 8%. As mentioned earlier, access to the private markets is much easier to access today and can be obtained at much lower thresholds. This is something to review with your Fairport Wealth advisor if you have an interest in these longer-term, somewhat illiquid alternatives to traditional stocks and bonds, an area to explore for sure. Well, I've dribbled on for too long, and to sum up, I have touched on a few topics on ways to take advantage of this market environment: tax loss harvesting, pre-funding retirement accounts or delaying required minimum distributions, gifting strategies, including the Spousal Lifetime Access Trust, and perhaps how to reconstruct your portfolio a bit by gaining exposure to a few recently available alternative assets, defined outcome ETFs, and the private markets. I hope you found this presentation informative and that it sparks some discussions with your advisors. If you have any questions or would like to discuss any of these ideas in further detail, as always, please reach out to your Fairport Wealth team. Take care, and here's to a better second half of 2022.